Welcome to Breaking News to Trading Moves. Welcome to The Debate. Today we are looking at a headline that challenges, really one of the most widely accepted rules in retail trading. The headline is Beyond the 1%, Scaling Risk to Edge.
Right.
And it examines the core premise of why risking exactly 1% per trade is, not always a smart rule.
Yeah, it's a controversial take for sure.
Exactly. And we can frame this issue pretty clearly by just looking at the winners and losers in the market. I mean, the winners are traders with proven execution, right? They scale their size directly to their exact edge, and they rigorously track things like their win rate, their average loss, and their drawdown.
Which is hard work.
It is, and the losers are the traders who use a fixed 1% rule to basically mask weak trade selection, overtrading, and, just lazy thinking. I am taking the advocate position today. I view the 1% rule as an essential guardrail. It limits downside damage, prioritizes account survival above all else, and forces beginners to stop trying to win everything back on one single reckless position.
And I'm coming at this from the opposite direction. I mean, the 1% rule, it creates a completely false sense of discipline. By applying a static number to every single situation, it treats unequal opportunities as if they were exactly the same.
Right.
And in doing so, it artificially caps the edge of highly skilled traders when they see premium setups, while simultaneously, letting beginners slowly bleed their accounts to zero under this illusion that they are practicing good risk management.
I hear that criticism, I do. But we really have to consider the primary objective for the vast majority of market participants. And that objective is simply avoiding disaster.
Well, sure.
Survival precedes success, right? You can't learn how to trade if you have no capital left to trade with. The 1% rule provides a simple, highly quantifiable way to control your downside risk.
Simple, yes, but maybe too simple.
Well, let's use a physical analogy here. Think of the 1% rule like a seatbelt in a car. I mean, wearing a seatbelt won't make you a professional race car driver.
Obviously not.
It doesn't improve your lap times, your cornering technique, or your spatial awareness on the track, but it guarantees that you survive a crash so you can actually drive again tomorrow.
Okay, I see where you're going with this.
Right? In the markets, having a fixed 1% rule ensures that one bad decision, one moment of panic or poor judgment doesn't end a career. It just puts a mathematical hard stop on ruin.
The seatbelt analogy is a great visual, but it's completely flawed for what we're talking about here.
How so?
Well, a seatbelt saves you in a sudden, catastrophic impact. But if you drive your car into a brick wall at 5 miles per hour, over and over and over again,
Okay, yeah.
your seatbelt works perfectly every time, but your car is still going to be completely totaled eventually. And that is exactly what the 1% rule does to an unskilled trader. It doesn't stop the ruin. It just changes the velocity of the ruin.
I mean, slowing down the ruin at least gives them time to learn, right?
Maybe. Where risk management can't be reduced to just picking a neat, static percentage. It has to be about matching your size to your statistical edge. When you mandate risking 1% on every single trade, you're assuming every setup deserves the exact same allocation. And that is rarely true in actual market conditions.
I'm not sure I agree that it's just a slow bleed, though. Let's look at the psychology of a drawdown.
Okay.
Without a fixed rule, traders just succumb to their emotions entirely. They experience a string of losses. The pain of the drawdown clouds their judgment, and then they take oversized bets to recover. It's the classic Friday afternoon revenge trade.
Oh, we've all seen that.
Right, you're down on the week, you see a setup, and instead of risking a small amount, you're like, I'm going to risk 5% to make it all back right now. The 1% rule acts as a behavioral circuit breaker against that specific impulse.
Sure, in theory.
Even if their overall decision-making remains weak, the math puts a strict boundary on the financial destruction of any single moment of weakness.
I'm sorry, but I just don't buy that. Let me tell you why. That circuit breaker you're talking about, it actually provides the trader with a false comfort of discipline.
A false comfort?
Yeah, it's a psychological trick they play on themselves. A trader can convince themselves they are acting professionally simply because they type a predetermined position size into their brokerage platform. Yet, within that 1% parameter, they can still overtrade wildly.
Well, they're still limited by the math, though.
Are they? Let's take your Friday afternoon example. A trader takes a loss on a tech stock in the morning, they are frustrated. They want to make it back.
Right.
Because they have this so-called rule, they don't bet 5% on one trade. Instead, they take 20 erratic, low-quality trades on the S&P 500 ETF, ticker SPY, over the next 3 hours.
Okay, yeah, that happens.
They risk exactly 1% on every single one of those trades. They completely ignore the broader market conditions, they get chopped to pieces, and they draw down their account by 20% in a single afternoon.
Ouch!
Exactly. But at the end of the day, they proudly claim they stuck to their risk parameters. The math looks controlled on a per-trade basis, but the aggregate decision-making is completely undisciplined. The rule just hides the underlying behavioral flaws.
But wait, if you strip away that 1% baseline, you're just inviting chaos. You're basically telling an emotional trader to size up or size down based on their gut feeling, which is a recipe for a blown account.
No.
I mean, if we abandon the safety net, aren't we encouraging reckless sizing? If a trader decides a setup just feels like a pristine A-grade opportunity because they are emotional about a recent loss, without a fixed rule, they might allocate 10% of their account to it. How is that an improvement?
We absolutely are not replacing static risk with gut feeling. That's a mischaracterization of the alternative.
Okay, then what is the alternative?
We are replacing it with a tiered system rooted in objective criteria. Instead of a universal 1%, risk should reflect quality through a structured hierarchy based on data, not emotion.
So how does that look in practice?
Well, for example, if a setup is unclear or the market context is choppy, the allocation is 0. You take no trade. If a trader is testing a new idea or trading a suboptimal pattern that doesn't quite meet all their criteria, the risk drops to 0.25%.
Okay.
For decent, everyday setups that hit most of the requirements, risk sits at 0.5%. The 1% allocation is strictly reserved for proven setups, and any risk higher than that is only supported by a strict rules and a robust multi-year data set, demonstrating a high probability of success.
Stop right there, because we really need to define what makes a setup proven or pristine in this context. You mentioned treating unequal opportunities unequally. Let's explain what actually separates an A-grade setup from a mediocre one mechanically, so our listeners know exactly what we mean.
Fair pushback. Let's break it down. An A-grade setup has a very tight, highly logical structural invalidation point.
Let's translate structural invalidation point for a second. We don't want to get bogged down in jargon here.
Sure.
You essentially mean the exact price level on a chart where your thesis for being in the trade is mathematically proven wrong, correct?
Exactly. Let's say you're looking to buy Apple, ticker AAPL, because it has established a very clear support level over the last 3 weeks.
Right.
The structural invalidation point is a penny below that support level. If the price drops below that line, the reason you bought the stock no longer exists. You get out immediately. A pristine setup has that clear line in the sand, plus high trading volume, plus it aligns with the overall market trend.
Okay, and a low-quality setup?
A low-quality setup is, say, buying a random stock just because it's moving fast and you have a fear of missing out. It doesn't have a clear invalidation point. You don't actually know where you're wrong. If you give the pristine Apple setup and the random momentum chase the exact same 1% allocation, you are completely misallocating your capital.
I see the logic there, I do. But that tiered structure requires an exceptional degree of self-awareness in data tracking.
It does.
For traders with a proven edge, strong data, and disciplined execution, I will concede that 1% might actually be too small for their absolute best opportunities. If a trader has tracked hundreds of trades and understands their exact win rate, their average loss versus average gain, and their maximum historical drawdown profile, then applying a rigid 1% across the board might reduce the compounding power of their mathematical edge.
Right.
But that relies on a trader genuinely knowing those metrics. And most don't.
Precisely. And that is exactly why the static rule fails them. It allows traders to bypass the hard work of tracking those metrics. If you just slap 1% on everything, you never have to ask yourself the difficult questions about your own performance data. You never have to calculate your baseline expectancy.
Let's make sure we clarify baseline expectancy as well. because that's really the core math behind why a strategy either makes or loses money over time.
Right. Expectancy is simply what you can expect to make, on average, per trade over a large sample size. Let's say you have a strategy that only wins 40% of the time.
Which sounds terrible at first.
It does, but when it wins, you make $3 for every $1 you lose. Over 100 trades, despite losing more often than you win, the math guarantees you will be profitable. That is positive expectancy.
Right, the math works out.
Conversely, you could have a strategy that wins 90% of the time, but when it loses, it wipes out 20 previous wins. That has a negative expectancy. A beginner usually has a negative expectancy. Giving them a 1% rule just means they will execute a negative expectancy strategy until their account hits zero.
But hold on, you're painting all trading styles with the exact same brush here. What about the variance between different types of market participants?
What do you mean?
Well, a one-size-fits-all rule falls apart completely when you look at the real-world mechanics of a scalper versus a long-term swing trader. I mean, a scalper executing fast trades with extremely tight stops operates on a completely different rhythm than someone looking for multi-week moves.
Oh, I'm completely with you on that. Let's look at the math there. A scalper might take 15 or 20 trades in a single 2-hour morning session.
Easily.
If they risk 1% per trade, a single bad morning where the market is choppy and stops them out repeatedly means a 15% drawdown before lunch.
Which is brutal.
It is catastrophic for a trading business. For that specific strategy, risking 0.1% or 0.25% per trade might be the only mathematically sound approach. Conversely, a swing trader might only take 2 high-quality setups a month.
Right.
For them, a 1% risk might be far too conservative, given the low frequency of their opportunities. If you only trade twice a month and your right risking 1% barely moves the needle on your account growth.
And the instrument itself dictates the real-world risk, which is a detail the static 1% rule completely ignores. Let's talk about liquidity and slippage, because I think a lot of retail participants fail to calculate how slippage aggressively alters their intended risk profile.
That is the exact mechanism that destroys static risk models. The market does not care about the neat little spreadsheet where you typed in 1%.
Right. Let's say you plan to risk 1% on a trade. You place your stop loss at the exact technical level we talked about earlier. But you're trading a volatile, low-float stock with wide spreads?
Or holding overnight?
Exactly. Or you're holding a position overnight and the company reports terrible earnings, causing the stock to gap down violently at the opening bell. Your stop order becomes a market order and it executes at the next available price, which might be miles away from your intended exit.
It happens all the time.
Suddenly, your theoretical 1% loss becomes a 4 or 5% actual loss. If you ignore spreads, liquidity, and overnight gaps, your percentage model breaks down upon contact with reality.
And this leads directly into how a professional actually evaluates a trade. Because we aren't just blindly hitting the 1% button, we have to use a diagnostic approach.
Okay.
Before allocating a single dollar, a trader has to walk through a specific set of realities. And the very first thing you have to ask yourself is exactly what you just described. What is the real worst-case loss if my stop slips? If I'm trading NVIDIA, ticker NVDA, during a highly volatile news event, and my stop gets blown past, am I actually risking 1% or am I functionally risking 3%?
And once you've figured out the true worst-case scenario, you have to justify taking the risk in the first place. You have to look at the math and ask, does this specific setup have enough edge to justify putting capital in harm's way?
Right.
Because if your historical data shows that a specific breakout pattern only works a third of the time, and the average gain is barely larger than the average loss, then risking a full 1% is mathematical suicide over a large sample size. The reward simply doesn't pay for the inherent risk.
Then you have to factor in the sequence of returns. This is where the math really humbles people. Every single strategy, no matter how good it is, will experience a cluster of consecutive losses.
Oh, absolutely.
Let's say your strategy wins 60% of the time. People hear that and think they'll win 6 out of 10 trades in a neat little row. That's not how probability works. Within a 60% win rate over a large enough sample size, you will inevitably hit a streak where you lose 8 or 9 trades in a row.
And if you're risking a fixed 1% per trade, an 8-trade losing streak means an 8% drawdown.
Right.
Many retail traders simply do not have the psychological fortitude to withstand an 8% drawdown without altering their execution. They start tweaking their strategy, moving their stops, or skipping valid trades because they are scared.
Exactly. Which brings up the psychological aspect of risk allocation. Why are you actually risking that 1%? Is it because the setup is genuinely high quality, or is it simply because the rule feels safe?
That's a great question.
It cuts to the core of the false discipline we discussed earlier. It is remarkably easy to justify a mediocre entry by telling yourself, well, my downside is defined. It's only 1%. You use the rule as a shield against accountability.
I want to push back on that slightly, or rather, offer a way out of that trap. There's a brilliant psychological filter you can apply when you catch yourself doing that. It exposes exactly what your true motivation is.
Let's hear it.
Ask yourself, would I still take this trade if I were forced to risk only 0.25% instead of my usual 1%?
Oh, that is the ultimate diagnostic tool.
It really is, because it strips away the noise. If reducing your position size to 0.25% makes you completely lose interest in taking the trade, it exposes a harsh reality about your mindset.
Yeah, it shows you don't really care about the setup.
It reveals that you don't actually believe in the structural edge of the setup. You're just placing the trade because you are bored, or you want the dopamine hit of watching a larger position fluctuate on your screen. If the setup is truly valid and the edge is real, you should want to participate in the movement regardless of how small the position size is. You should want to capture the mathematical edge.
The fixed percentage is so often used to feed the desire for action rather than to execute a proven edge. Smart risk management is fundamentally about knowing your strategy, knowing your numbers, and most importantly, knowing yourself.
Absolutely.
It requires looking at the actual properties of the market environment, the volatility of the asset, the liquidity of the order book, the precise structural invalidation points, and calculating your risk backwards from those realities. You look at what the market is giving you, and you size accordingly. You don't project a static percentage forward onto the market and expect the market to respect it.
I'm not completely abandoning my defense of the baseline rule, however. I hear everything you're saying about the math and the psychology, and I agree that the 1% rule is incomplete. It's clearly flawed when applied blindly without market context.
Sure.
But it remains a vital protective layer for a huge portion of the market. Let's go back to our starting point. For a trader who has not yet built that robust, multi-year data set required to run a tiered risk system, a strict 1% rule at least guarantees they survive long enough to gather their data. If they try to scale risk to an edge they haven't proven yet, they'll blow up.
I can agree with that as a boundary condition. If we are talking purely about a beginner's first 6 months in the market, fine. We converge on the idea that a strict maximum risk can protect a novice from sudden catastrophic ruin.
Good.
The danger lies in stopping there and calling it good risk management. It's merely training wheels. It can equally hide weak trade selection, encourage chronic overtrading, and stunt a trader's long-term evolution. The transition from an amateur who relies on strict rules to a professional who manages dynamic risk demands that capital must ultimately be scaled to the quality of the opportunity, not arbitrarily assigned just because it feels comfortable.
It forces us to reconsider how we categorize our daily decisions in the market. A static rule offers comfort, but comfort rarely produces outperformance in any competitive arena.
Very true.
Let's leave the listener with this final thought. We started by looking at the mechanical comfort of the 1% rule, that safety net we all learned on day one of our trading journeys. But as we strip away the illusion of discipline, we are left staring at the raw quality of our own decision-making. If you are risking 1% on every single trade you take, ask yourself honestly, does every single trade really deserve the exact same risk? This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.